and welcome to the August episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. It is great to have you with us. Coming up on today's show, a new lineup of municipal bond ETFs designed to take a bite out of your tax burden. Plus, small cap stocks have been getting a lot of attention these days. We will dive into one small cap ETF that's aiming for some big growth potential. And finally, we will analyze some of the challenges facing dividend investors and profile one ETF that aims to solve some of those challenges. But first, to kick things off, as we always do, we have Maital Legum from the New York Stock Exchange. Maital, it is great to have you with us. Thanks for being here.
Good to be here. Thank you.
All right, let's begin with the latest update on ETF launch activity. What are we seeing right now on the NYSE?
Certainly, there is no summer break for the ETF industry as we continue to see strong momentum and growth as we head into the second half of the year. In July, 66 ETFs launched, raising almost $13 billion in assets under management. This brings us to an industry total of 3,624 ETFs with over $9.4 trillion in assets under management today.
Yeah, the ETF marketplace continues to hit new milestones, and active ETFs have been some pretty big contributors. How much of an impact are those active ETFs having?
Active ETFs have continued to have a big impact on the overall ETF marketplace, with 72% of all launches and almost a third of all cash flows going into actively managed ETFs. In Q2, we saw active ETFs bring in a record high of $65 billion in cash flows, bringing the total of the first half of the year to $129 billion. That's more than all of 2023. And of course, as a reminder, subscribe to our free active ETF newsletter at thehomeofetfs.com to follow all that's going on in the industry today.
And Maital, what are some of the other trends that you are monitoring?
We still see a focus and strong demand for fixed income ETFs, as a third of all cash flows have gone into fixed income funds this year alone, with record inflows in July. This month, we also saw a new wave of crypto ETFs as the newly approved Ether products made their splash onto the scene, with almost $9 billion in assets under management raised across the various offerings. And lastly, as we always say, it continues to be all about education. Go to ETFcentral.com to learn more about the CETF designation, and be sure to check out our ETF Central podcast, available on all streaming platforms.
All right, Maital Legum, thank you so much for joining us from the NYSE today. It's great to have you.
All right, good to be here. Thank you.
And just a quick reminder to watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. We also simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms. So be sure to check us out there. When it comes to the stock market, growth investors have many choices, and among these are small cap stocks, which have many of the financial attributes that high growth investors are looking for. Smaller companies may be more agile and quick to innovate. They also have the potential to grow faster versus some bigger companies, and they can also become acquisition targets. Well, here to discuss a new ETF that targets small cap stocks with an index-based approach is Cole Pearson, president with OneAscent Investments. And Cole, it is great to have you with us.
Thanks, Stephanie. Great to be here.
Okay, so before we talk about the OneAscent Small Cap Core ETF, and your ticker there is OASC, can you define small cap stocks and why this is an area of the stock market investors should consider?
We use the S&P 600 as our index. You mentioned our fund's an index-based fund, and so we let them define small cap for us. And today, the average market cap, the median market cap in that index is about $2 billion. It ranges anywhere from 200 to 8.4 billion. So a pretty good size range. Small is relative, right? To put that in context, the S&P 500 ranges anywhere from 5 billion to 3.5 trillion. So a really big range. We're focusing there in that 2 billion or so target. So that's what small cap is for us and how we define it. As you mentioned, it is an interesting area of the market right now. Through last week, really the last month, we've maybe started to see a trend change where the S&P 500, the large cap stocks, were down roughly 3%, while small cap stocks were up between 4 and 5%. So we're starting to see a reversal. If you look back over history, you can see Dr. Kenneth French, who's of Fama and French fame, did a study looking at 10-year rolling periods, so long periods of time, the entire stock market history, and he found that small cap stocks historically outperform large cap stocks. There's only 3 exceptions when that hasn't been the case. It was in the mid-1950s, the early 1990s, and this most recent period, really since the great financial crisis. So we believe we're starting to see that change. Part of that reason is valuation. Today, small cap stocks are cheaper than large cap stocks, really across any metric that you look at, whether that's price to equity or price to sales or price to cash flow. Really, when we look at the relative valuations between large and small, we're seeing discounts that we haven't seen really in the last 20 years. So valuation is important. That's the price you pay to enter a market. But we also believe that the fundamentals are there too in the small cap space. Really, over the last several years, earnings growth, profitability has really been carried by what's known as the Magnificent Seven. Really, a handful of stocks in the large cap space have been kind of the lion's share of the growth. But forecasts are seeing that broadening out and really seeing small caps recovering faster here in the next 1 to 3 years.
So it sounds like there is opportunity there. The Small Cap Core ETF, your ticker once again, OASC. Tell us a little bit more about your investment strategy. You guys use an index-based strategy and some of the holdings.
The OneAscent Small Cap Core ETF, it's an index-based, diversified core U.S. small cap equity fund. It's built, though, for investors who desire to align their values with their investments. So there's really a couple elements going on there that maybe I'll unpack. Index-based, what does that mean? Well, it means that we simply are trying to replicate the returns of an index. So we're again, the S&P 600. But for us as values-based investors, that means eliminating certain companies out of the universe that we believe are causing harm, involved in parts of the market or sectors that we believe don't align with our investors' values. So what we do is we simply take the index, we apply those values-based screens, and then we use optimization techniques, optimization tools to actually go back and recreate the index with what's left, and that's the fund. So there's about 200 or so holdings in the fund. We dial a tracking error. We target a tracking error of about 2%. So we're trying to, again, perform like the risk and return of the index, but do so in a way that aligns with our investors' values.
So then how would investors and advisors utilize OASC as part of their overall diversified portfolio?
I think this fund is really great for investors who are looking to diversify their portfolios. As I mentioned, there's been a lot of concentration in the U.S. large cap space really over the last decade, where if you look at an index like the S&P 500, that's what most people know about and think about. The top 10 companies in that index make up 34% of the index. When you look at small cap, that number is closer to 6%. So it's a way to diversify. So investors who are looking to diversify their portfolios have more opportunity set, more shots on goal, so to speak, as they think about the next 10, 15, 20 years of growing their investment balance. And again, our fund is really designed and intentional to align with people's values. We eliminate companies that we believe are causing harm. We seek to elevate those companies that are bringing blessing to the world.
Cole Pearson, thank you so much. It's so great to have you today on First Look ETF.
Great. Thanks for having me.
Generating consistent and reliable income is a top priority for many investors, especially those approaching or entering retirement. So what are the challenges facing dividend investors? Well, here to discuss that, plus a new ETF designed to boost income and equity returns, is Jeff Cullen, Managing Director of Cullen Capital Management. Jeff, it is great to have you.
Great. Thank you, Stephanie. It's great to be here.
Okay, before we talk about the Cullen Enhanced Equity Income ETF, and your ticker there is DIVP, what are some of the current challenges right now facing equity income investors?
Well, the biggest challenge is probably facing investors is just where to get that monthly income that they're looking for. On the equity income side, it is choice probably, Stephanie. There's a lot of choice out there for them to make. There's dividend-oriented ETFs that just go after yield. There are dividend growth ETFs that focus on low dividend payers that have dividend growth. There's some in between. And then there's this whole new category of covered call ETFs that people have been running for a long period of time that are now available in ETF format that are giving very strong, high monthly income to existing clients. And there's a lot of choices out there.
The Cullen Enhanced Equity Income ETF, and again, your ticker is DIVP. This is your firm's first ETF, so congratulations. Tell us more about the fund and its investment strategy.
So the background here is that we've been running this strategy in what we call a separately managed account for the last 13 years. The strategy itself has about $1.8 billion in assets, and we've been having it in a separately managed account for the last 13 years. As I mentioned, the focus of the strategy is to generate income. The yield on the strategy has ranged between 7 and 8% over the last 13 years, each individual year. So what we've seen is that as clients start to really like ETFs. And we heard earlier today on how fast growing the active ETF marketplace is. Clients started to ask us to make this strategy available into an ETF format, because this is a good way for them to actually implement the strategy inside of their individual brokerage accounts or financial advisors inside of individual client accounts. So that's why we decided to make the ETF. The symbol is DIVP, DIV for dividend, and P for premium income. What the strategy does is we buy between 30 and 40 large cap value dividend paying securities, and then we simply write covered calls on between 25 and 40% of the portfolio for additional income. This kind of strategy, financial advisors have been doing for years and years. We just were able to institutionalize it, put it into a packaged product that people can use today.
Can you give us some of the holdings and tell us why this was an attractive strategy for DIVP?
We think it should appeal to anyone who's looking for income inside of portfolios, whether it's taxable or non-taxable accounts. And we're thinking it's just the sleeve of the solution. So while you might have a current 60-40 allocation portfolio between equities and fixed income, DIVP or covered call ETFs could be a small portion of that fixed income allocation that you're probably applying to generate good cash flow for clients on a consistent basis. Our strategy is really focused on generating good, sustainable monthly income for clients. So people who should be interested or looking at this strategy would think about a monthly cash flow or looking for an allocation toward either a fixed income or a conservative equity allocation where you can generate good, consistent cash flow on a monthly basis. And it's really just a solution that should be a part of someone's overall asset allocation. Because you have to remember that the portfolio is 100% equities. We're owning dividend-paying equity solutions, and then we're writing selective covered calls on top of those. So you do have the volatility of an underlying equity portfolio, but you have the income and the dividends, which tend to cushion things a little bit if there's volatility in the marketplace.
All right. Thank you, Jeff. We appreciate your insights. Keep up the good work. It's great to have you.
Thank you, Stephanie.
Reducing the bite of taxes helps investors to keep more of their money where it belongs, and that, of course, is in their pockets. Well, one strategy for limiting the tax bite is municipal bonds, and here to explain how they work and a handful of ETFs targeting them is Scott Diamond, co-head of municipal fixed income at Goldman Sachs Asset Management. And Scott, it is a pleasure to have you today on First Look ETF.
Sure.
So before we talk about your Munibond ETF suite, how are municipal bonds different than other types of bonds?
Quite frankly, I think of the U.S. municipal bond market is quite unique relative to how the U.S. finances infrastructure compared to the rest of the world. For an issuer, the interest that they pay is going to be exempt for the investor, and that lowers the borrowing costs, which, as everyone knows, a lot of infrastructure is needed to be improved, and this helps to stretch out the dollars. For an investor, I would say three things are really key. Number one, you already hit it on the head, the tax-exempt income. The interest income that an investor earns on a municipal bond is likely going to be exempt from federal taxes, and depending on where you live, it could also be exempt from state taxes. Second would be credit quality. The default rate in the municipal bond market has historically been extraordinarily low, particularly when you compare it to corporate bonds. The average credit quality of the municipal bond market is going to reside somewhere in the high single A or low double A. Again, compared to corporate bonds, where the average credit rating is going to be somewhere around single A minus, maybe triple B plus. So credit quality works to your advantage. And then finally, number three, for an investor who needs to think about an overall asset allocation, the correlation of municipal bonds to equity markets is extraordinarily low. So if you're trying to build an overall well-balanced portfolio, municipals may help to lower some volatility.
So Goldman currently has 4 municipal bond ETFs in your portfolio of offerings. Can you tell us a little bit more about the lineup?
Super excited about these 4 actively managed ETFs. We are pretty big municipal bond investors, and I'm thrilled that this is sort of an extension of what we are already currently doing. The lineup, 4 municipal ETFs. Let me break it down into 2 buckets. The first is our dynamic municipal franchise. We have a dynamic municipal income fund that is designed to be a go-anywhere vehicle. We can look across all corners of the market, across the country, across the maturity distribution, across credit quality to find the best value for our investors. What we're doing with two of these ETFs is basically extending that whole concept. GCAL, GCAL, is a California Dynamic Municipal Income Fund, and G-Money, GMNY, is a New York Dynamic Municipal ETF Fund. Both have that same dynamic flexibility. We can be as short as 2 years or as long as 8 years from a duration or interest rate sensitivity perspective. We can go up to 30% in high yield. However, for these two ETFs, we're going to be focused specifically on in-state bonds. Investors that reside in California or New York, they know the sting of high tax rates. So being able to look across all corners of the market, particularly in those states, we think can be beneficial to those investors over time. The remaining two are going to be national municipal ETFs, which, Stephanie, simply means that we can look anywhere across the country to find the best value. The first is ultra short, GUMI, gummy. And that's going to have an average maturity of somewhere around 1 year or an interest rate sensitivity of around a half a year. It will be, as I said, across the country, and it's only going to be investment grade securities. So think low volatility. The last one is the result of a lot of incoming inquiries that we had for folks looking for some type of an investment that gives you more than some passive, but maybe not as much flexibility as our dynamic offerings. So the fourth final ETF that we're going to talk about is GMUB, the Municipal Income ETF. That is going to be, as I said, national. It's intermediate in its duration scope, and it has only a 15% allocation to high yield when we think that that's appropriate for investors.
And what type of investor might the Goldman Sachs municipal bond ETFs appeal to?
You know, Stephanie, number one, it has to be someone that does pay U.S. taxes, right? Because the income that's being generated is going to be exempt from those taxes. For the Cal and the New York option, I would say that those investors reside in those states, and given that high tax rate, they really want to try to maximize the state income tax. Give enough flexibility that you can look in all corners of the market. For something like an ultra short fund, think of an investor that maybe has a real short time horizon for that investment. Not a day-to-day cash investment, such as a money market fund or, a checking account, but maybe it's a little bit longer of a window that you're thinking about. Could be a tax payment that's going to be due in the spring. Low volatility there should make that a better option. And finally, for the national, I think you got to have somebody that's just looking for the broadest view of the municipal bond market, that's looking for a well-diversified product, and hopefully a lot of tax-free income.
All right, we are out of time. Scott, thank you so much for joining us. We appreciate your time.
Thank you.
And that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comments section below and by hitting the like button. A big thanks to all of our guests, along with Maital, Legum from the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thanks for watching. We'll see you next time.